Hi folks, Scott here, and this is the wrap for Wednesday, May 8th. So lots of interesting things going on in the markets, ripping to the upside, parabolic-like move, technically the fifth consecutive 200-day high close, because if you look at a cash index, which is what I use for calculating closing prices, this day right here, hold on, I'm updating some charts. This day right here was also a 200-day high close, and then these four here. But I'll show the numbers for four consecutive 200-day high closes because this is too close for me to count tomorrow for our members. If you want to see those results, you can watch tomorrow's video and see it after the fact. But what I thought would be more interesting to show you would be the results of fading gaps following this very unique 3-day pattern. What did that do? Oh, that went back to the cash index, sorry. And this unique pattern is specifically green candle, higher close, preceded by another green candle with a higher close, preceded by another green candle with a higher close. And each of these candles is consecutively bigger as we progress. So today was the widest range of the prior 3 days, and yesterday was a bigger range than of its prior day. So real unusual action here, and I thought it'd be interesting to test because I don't know that I've ever tested that. And let me show you the results for fading gaps following this unique 3-day pattern. There you go. Now, if you were in the trading room and saw these numbers are a little different because I had failed to include 3 consecutive higher closes. That's why the sample size is a little smaller. Shows a couple things. Odds favor, one, it's unusual, right? It's only happened 23 times in the past 11 years or so. Favors a gap down by a little bit. Gap down looks to be above average win rate. Hard to tell on profitability because they had one big loser here using an end of the day stop, which we don't do. So this is probably a profitable scenario for a gap down using our MTG intraday stops. Gap up 9 for 9 historically. So real unusual action. Favors gap fill. I think because it's probably a parabolic type of move. As I just showed you, is those increasing candle sizes and consecutive higher closes. But interesting nonetheless. So gap down is maybe okay. Oh, hold on, I forgot. A gap down, we don't know, and here's why. I also ran in the trading room at the end of the day, as I often do, in preparation for my wrap and a little bit of a value-added service for our members. I ran it with 4 consecutive, increasingly larger green candlesticks, right? Because this is 4. 1, 2, 3, 4. It has only happened 3 times. 2 times it gapped down, 1 time it gapped up. So today has only happened 3 times previously. I don't think it's including today's action. 3 times. That tells you just how unusual price action is right now. Anyhow, gap up is what the real takeaway here looks to be a good setup if we get one. As always, I'll defer to our gap guides and rerun these numbers for our members in the morning using our MTG stop parameters. All right, let's get to I've got a webinar. Check your email. In my quarterly wrap, I discuss how to predict using history where the markets and index will close. I'm going to do a webinar on that. I have a blog post on it as well, which you can go ahead and read. But anyhow, sign up there. It's next Wednesday, a week from today. Now let's look at the worksheet going into today. We had small gaps down between the close and the low. Weighted average of all 8 indices was slightly attractive, 67% at 1.2. Doesn't quite meet my criteria, but certainly worthy of consideration. Unique day factors, unique patterns, none. As you might expect, if I showed you the individual indices, which I'm not going to do, actually I'll do it super quickly because I know a lot of you like to see those. So making up that 67% win rate and 1.2 profit factor, the following numbers. The UCO zone, between the open and the close of yesterday, and the ES, 74% win rate, 1.4 profit factor, check. YM, check, looks good. NASDAQ actually closed down yesterday, so this is a DCL zone opening between these 2 levels here, close and low. Not a check, that's an X. That's been historically a money loser. And then the Russell UCO zone dead neutral. Looking at the ETFs, Spider confirmed, Diamonds confirmed. Actually, Qs were slightly attractive in the DCL zone. Didn't meet my criteria, and again the Russell was dead neutral. So you had 4 that met my criteria, 1 that didn't. That's just not a real strong setup for me. It's not terrible because everything, with the exception of the Qs, were okay. There were no unique patterns that I showed in the worksheet, and my core patterns that showed up. So I did additional analysis to try to decide how and if to trade this gap. As I mentioned last night's wrap, down gaps after 3 consecutive 200-day high closes, strong numbers. That was a positive. Small and mid-sized down gaps in the UCO zone, opening above the high of 2 days prior. That's my heat gap. You can read about it in the members download area, or used to be an article in the SFO magazine site. Anyhow, it's in the members download area. About the heat gap, which meant it had to open above 1615 during a bullish market. Real strong numbers there as well. And thirdly, the only real, and there were lots of other patterns, quite frankly, that were positive, that were very nuanced, though, in some of these smaller sample sizes, which I don't like. This is one that did concern me. Down gaps during the first half of May. During a bullish market, just in general, it's a bad setup. But it's really stretched to the upside, it's probably, maybe even worse. So that was really the big flag today, along with only technically 4 of the guys meeting criteria and 1 not. So, as I said, the gap guys show slightly attractive historical setups for fading down gaps in the UCO zone. Worksheet unique data and above show mostly positives for fading down gaps. So if the ES opens above 1650, that was yesterday's opening price, that would by definition mean it would have to be in the UCO zone, and below 1618.50, which as it turned out was exactly 2 points below. Let me get this right, hold on. I got a lot of numbers in my head. Yeah, exactly 2 points. I wanted 2 points of opportunity below settlement price. I don't talk about settlement price, but it is the third level to pay attention to, in addition to the last trade as of 4:15 Eastern, as well as the last trade as of, or the close as of 4 o'clock. That accounts for the ETFs. Then I was going to fade the open with a half-size position. So what I meant by all of that, this is a more narrow window than normal, but the gap guys just weren't overly strong. I mentioned last night's video, I'm in a drawdown and my standards go up, so I needed to have at least 2 solid points of opportunity before I got to the most conservative target, which would have been the settlement price at 1620.50, in order to risk a slightly bigger stop, because the heat gap requires a slightly bigger stop most of the time. So for me, when I did the math on my approximate win rate, in order to come up with a compelling expectancy and just make it a strong trade, this was my criteria. I don't normally get this nuanced unless I'm in a drawdown and my standards have to go up. As it turned out, it looked like I may get lucky and have it open there, but we ended up rallying right into the close, or correction, right into the open at 1619.50. So that still had 1.5 points of opportunity to the 4 p.m. close, but only a point for settlement. So I passed on it, wasn't willing to risk 6 or 7 points to only make 1, and missed a small winner. No big deal. Hold on, these are wrong. There we go. Small gaps down, they all filled. Could have traded them all and made a little money. Quite a few of our members did trade them, longtime members following their plans. Way to go, because the data was certainly not bad today. I missed it. Now, let's cut to the chase. 15-minute first hour range numbers for the rest of the day, because it was really interesting. I'm a little wound up. I'm going to try to talk fast and keep this as brief as possible. 15-minute and first hour range numbers were mixed, showed no clear edge other than the low breakout. Correction, the low fade has some positives in the 15-minute numbers. That did not trigger. So once we broke more than 2 points, so this is a discretionary concept, but I'm trying to teach you, probabilities are just simply, which is what drives my decision making for my core money. You have to be patient. You have to wait for the market to come to you. When the market's moving, however, like it is right now, I want to trade when I believe I can identify an edge on a discretionary basis. Good movement, equals good opportunity as long as I can be smart and have good payoffs. So, and I always have derivative effects of the probability analysis I conduct in the morning, right? When I'm doing gap analysis and I'm so deep in the numbers, backing up, I get a feel for what's going on with the markets. So even though I may not directly make a discretionary trade based on probabilities, in my mind, that's actually what I'm calculating, because that's what every good trader, it's what you have to do. So as I summed it up, just to not to necessarily just pat myself on the back, I made a very compelling argument that the odds were the market was going to go up and finish up today. The gist of the argument was we were getting technical confirmation of having gap down and now traded through gap fill, hit extended target, and trading more than 2 points above yesterday's highs. Market internals were improving. In my mind, the sellers had missed the opportunity to drive the market down. This was very bullish activity. And the question I asked everyone, and I ask myself this question every day when I'm looking at the markets, who is in the most panicked position? Who's getting emotional? Who has the biggest drive to do something? Sellers or buyers? And that answer was buyers today. Why? Well, it's real simple. The market missed its opportunity to sell. So sellers, if they were going to show up, would have been doing it on a gap down this morning, and they did not. So without sellers showing up in the early session and looking at this price action, you notice some folks that are still stuck short. They're going to be absolutely panicked. This has been an unrelentless unfilled up gap since the unfilled up gap, just driving to the upside with very few pullbacks. There are still big money stuck short. Bulls know it. So the only people that had to sell were going to be, correction, the only people who had to buy were the people still stuck short. So that was my motivation for believing we'd likely finish up today. And as such, I set up a pullback to go long at 1622, one tick above the high. It missed me, did not fill me there. I said if we broke through R1, which was at 1614.75 on our price guides by at least 2 points, I'd buy a pullback to 1625. It didn't. It only rode 1.5 before I left the trading room. But I noticed during lunch it rallied up, went more than 2 points above R1. That's just confirmation of bullish continuation. I set up an order to go long at 1625. And yes, I was filled. So I set up on a discretionary trade +2 or +5 points. Told people I thought 1630, which was the next confluence area on our price guides. That's a tool available on our website. And I post on our charts each day, on different charts, my trading room charts. Was a reasonable target. In fact, I was so confident based upon the price action that I decided to get a little bit greedy and hold the whole position for +4. So wanted to go for 1629 for 1625. Because of that, I didn't take any off when it got to +2.5 here. It then rolled over, and instead of using my normal 3-point stop like I normally do, I try to over-engineer it, and I recognize that if price went more than 2 points below R1, it would likely go down and test the highs, where I actually had another order sitting, an even larger order sitting. So I decided it was okay to go ahead and engineer this, save me a couple ticks, and guess what? I got stopped out at the absolute, I was going to say a bad word, similar to frickin'. I don't say that word anymore, but that's what I was thinking. See the low there, 1622.50. So I was filled precisely. That was good luck. My greed got me here, or my judgment, a little bit of bad luck, got stopped at the absolute low there. And here's the worst part: did not get filled long at 1622, which I told people in the trading room I would scale out +2 and +8. I was shooting for 1630, and it went to 1629.50. So absolutely right directionally. I made good calls all the way around. I just didn't execute my one discretionary trade very well. Pretty frustrating, frankly, to not get filled down here, and it didn't give me any other chance. It just kept running. So I lost a little bit of money, tiny bit of money, inconsequential on the discretionary trade up here. Missed what would have been a great discretionary trade, and missed a tiny winner on the gap. So it was an interesting day. Learned to leave my darn parameters alone on my discretionary trades. They're there for a reason. I used 3 points for a reason. And, gave me confidence that my read on the market was good. And that's always a good thing. So, there you go. That's my long-winded wrap for Wednesday, May 8th. Have a good one.